Hello class, welcome to chapter 2, the recording process. We're still in week 1 of accounting. This is a very important chapter. We'll go over debits, credits, journal entries. So let's go ahead and get started. Go over the study objectives for the class. You'll see this in the class, so we'll just zip right through that. Gives an overview of the chapter, debits and credits, as far as the account. Explanation of the basic accounting equation, steps in the recording process, which include the journal, the ledger, the recording process illustrated, summary illustration of journalizing and posting, the trial balance, limitations, locating errors, and use of dollar signs. So what is the account? Basically, the account is a record of increases and decreases, whether it be in a specific asset, liability, equity, revenue, or expense account. So all different types of accounts are either assets, liabilities, equities, revenue, or expenses. We can see the terms debit and credit. Debit and credit are like signals. When you're driving a car, you signal, it's either telling you going left or that you're going right. That's all they are. Doesn't mean favorable, not favorable. It just means debit means left and credit means right. And we'll see below that an illustration. An account can be illustrated in a T account form. So we'll see over here, debit, this is the left side of an account. Credit is the right side. Oh, I'm sorry, yeah, right side, left side. And the name of the account goes here, whether it be cash, accounts receivable, revenue. So an account has three parts, the debit, the credit, and the name of the account. In accounting, we have something called a double entry accounting system. Each transaction must affect two more accounts to keep the basic accounting equation in balance. The basic accounting equation is the only equation that you'll see in accounting. It's going to be assets equals liabilities plus owner's equity. On the left side of the accounting equation, you have assets. On the right side, you have liabilities plus owner's equity. So whatever affects one side has to have the same effect on the left side or the right side. So the left has to equal the right. Recording is done by debiting at least one account and crediting at least another. So there has to be a debit and a credit in each transaction. And debits must equal credits. And that's going to happen in every single transaction. There's no deviations from that rule. Debits must always equal credits. So if debits are greater than credits, the accounts will have a debit balance. So here's an example. No name on the account. We can call this cash. Debit is the left side. Credit is the right side. 3 transactions here. And you can see we posted to this T account, which resembles the general ledger. We have a $10,000 transaction debit here, $8,000 transaction debit, and a $3,000 transaction credit. So that balance, this is going to be a debit balance. Again, let's just call that cash. Because we add up 10 plus 8 equals 18 minus 3. And that would have it that $15,000 balance. If credits are greater than debits, the account will have a credit balance. Let's just call this a liability account. Let's call this accounts payable up here. Just say there was a debit to $10,000 for $10,000. Transaction 2 and 3 were $3,000 and $8,000 respectively. So we're going to have $11,000 here, and we're going to subtract 10, and we'll have a balance of $1,000. Very important here, debit and credit summary. The normal balance is a debit for assets and expenses. The normal balance is a credit for liabilities, equity, and revenue. And it's definitely worth looking at this, and feel free to hit pause on this. Assets, their normal balance is a debit. Debits increase assets. Credits decrease assets. And the normal balance for each account is what increases it. So you'll see here, what increases an expense is a debit. So what increases that balance is the normal balance. Conversely, a credit decreases an expense. Let's go to liabilities. Liabilities will be the opposite of of assets. So liabilities, a debit decreases liabilities. It's actually a good thing. So again, it's not favorable or not favorable. It just depends on the account that you're working with. The normal balance of a liability is a credit. Why? Because credits increase liabilities. So that's normal balance. Normal balance of a liability is what makes it exist. When we increase liabilities, or if we don't have any liabilities on the books, or we're increasing it, we're going to credit a liability account. Owner's equity. A debit will decrease owner's equity. A credit will increase it. And again, the normal balance is what increases it. Just like the normal balance here for a debit, for an asset is a debit because it increases it. Owner's equity, the normal balance is a credit. So think of it this way: liabilities, equity, and revenue. Even though they're talking about three separate mutually exclusive things, debits and credits are going to be the same thing as far as what increases and decreases them. So revenue, we decrease revenue with a debit, and we increase revenue with a credit. So in other words, if we want to increase revenue, we debit accounts receivable and we credit revenue, which is going to be the normal balance. And you'll see this through journal entries and transaction analysis, as we'll see later. Debits and credit summary. Okay, this is what we just went over, and here's just another slide on that. So debits increase assets, and debits also increase expenses. You'll see up here balance sheet. These are balance sheet items. Assets, liabilities, and equity accounts belong on the balance sheet. And that's one of the major financial statements that we'll see. Revenue and expenses go on the income statement, and that's a second major financial statement that we'll see. Debits decrease liabilities, equities, and revenue. Or should say equity and revenue. Conversely, credits decrease an asset, decrease an expense. So you'll see asset and expense usually have the same, will definitely have the same debits and credits. Liabilities, equities, and revenues are affected by credits the same way, they increase them, and they're affected by debits the same way as you'll see the decrease. So let's try a question. Read through that a little bit. Debits, A, increase both assets and liabilities. B, decrease both assets and liabilities. C, increase assets and decrease liabilities. And D, decrease assets and increase liabilities. Okay. The correct answer is C. Debits increase assets and decrease liabilities. Discussion question. Maria Alvarez, a beginning accounting student, believes debit balances are favorable and credit balances are unfavorable. Is Maria correct? Let's go back there. Again, remember what we said about favorable, unfavorable? Maria is not correct. It just depends on the type of account that the debit or credit is affecting. So in review, assets and liabilities. Normal balance of an asset is a debit. A credit decreases assets. Here we go. Assets, debits should exceed credits. So that's the normal balance. Liabilities, credits should exceed debits. Again, normal balance. Normal balance is on the side of the increase. Side of the increase, side of the increase. Owner's equity. Owner's investments and revenues increase equity, which is a credit, normal balance. So owner's equity consists of investments from the owner and revenues from the normal course of business. Those both increase owner's equity. Owner's drawing and expenses decrease owner's equity. So there's two that increase and there's two that decrease equity. The latter, drawings and expenses, will decrease equity. So we'll see right here, owner's equity, owner's capital, basically the same thing. Owner's drawing is going to be opposite from owner's capital. You have the normal balance, which is a debit, and the credit, which decreases the drawing. So owner's drawing, that's basically just stating that the owner wants to take money out of the company. And we would do that by debiting, drawing, and actually debiting, drawing, and crediting cash, because cash would be leaving the business. Revenue and expenses. The purpose of earning revenues is to benefit the owners. The effect of debits and credits on revenue accounts is the same as their effect on owner's capital. Expenses have the opposite effect of revenues. expenses decrease owner's equity. As you can see, revenue is increased by a credit, expense is increased by a debit. Another review question. Accounts that normally have debit balances are assets, expenses, and revenues. Well, assets have debit balances, expenses have debit balances, but revenues don't, so it's not going to be A. Assets, expenses, and owner's capital. Assets and expenses have debit balances, owner's capital doesn't. So it's either between C and D. Assets, liabilities, and owner's drawings, or assets, owner's drawings, and expenses. So out of these accounts, which ones have a normal debit balance? And the answer is going to be D. Assets, drawings, and expenses. So let's talk about the expansion of the basic account equation, which is the relationship among the assets, liabilities, and owner's equity of a business. So the basic equation up here, you'll see assets equals liabilities plus owner's equity. And what happens on this side of the equation, the left side of the equal sign and the right side of the equal sign, they have to balance. So the expanded equation states that assets, the same thing as up here, liabilities, the same thing up here, and owner's equity. Over here we have owner's equity having 4 subcategories: capital, drawing, revenue, and expenses. Owner's capital increases equity, drawings decrease equity, revenues increase, and expenses decrease. These are from the normal course of the business, revenues and expenses. These are incidental, non-core, meaning owner investments and owner's drawing. The equation must be in balance after every transaction. For every debit, there must be a credit. You'll never see a deviation from that rule. That will always be the same no matter what. So steps in the recording process. Basically, we analyze each transaction, enter the transaction to a journal, transfer the journal information to ledger accounts. Business documents such as sales slip, invoice, a check or bill, or a cash register tape, these provide evidence that a transaction has occurred. So the journal, which we typically mark as the book of original entry, you'll see that a lot, either journal or the book of original entry, the same thing. Transactions recorded in chronological order, meaning January 1st, January 2nd, January 3rd, sequential order. The journal contributes to the recording process as it discloses the complete effect of the transaction, provides a chronological record of transactions, again, date order, helps to prevent or locate errors because the debit and credit amounts can be easily compared. So let's see an illustration for journalizing. On September 1st, Ray Neal invested $15,000 cash into the business, and SoftBite purchased computer equipment for $7,000 cash. Okay, in this situation, Ray Neal is the owner, and SoftBite is his business. So Ray invested $15,000 cash into the business. Let's see what that looks like. So debit cash for $15,000. And we're recording this in a journal. The credit, as you can see the indentation here, Ray Neal capital. Remember, we increase capital with a credit, and we increase cash with a debit. And remember, debits equal credits no matter what. So these always have to balance. So it's actually 2 transactions here. The next transaction is going to be the purchase of computer equipment for cash. So we're going to increase an asset, which is going to be computer equipment, and we're going to also decrease an asset, which is going to be cash. So we increase assets with a debit, and we decrease assets with a credit. Again, debits equal credits. Assume that on July 1st, a Butler company purchased a delivery truck costing $14,000. It pays $8,000 now in cash and agrees to pay the remaining on account. On account, keyword. That's a keyword. If it's liability, it's going to be accounts payable. If it's an asset, it's going to be accounts receivable. Accounts receivable is money owed to us, the company. Accounts payable is what we owe to creditors. So we're going to debit delivery equipment for $14,000, and we're going to credit cash for $8,000. But look at this, debits and credits do not equal. So we're paying the remainder on account which is accounts payable, 6,000. So the credits, you can tell by the indentation, and you don't have to worry about that in the homework problems. You can just see that in the textbook. 8 plus 6 equals 14. Debits and credits are in balance. So a general ledger contains the entire group of accounts maintained by the company. Includes the asset, liability, owner's equity, revenue, and expense accounts. Individual asset accounts, individual liability, and individual owner equity accounts. And we can actually read that in the book. What would Sam do? Gives you some kind of do-it-yourself kind of explanation, and you'll see that in the back of the chapter. Okay, so the standard format of an account. A T account is used more in a textbook, and it basically replaces what's called a ledger, which you'll see in normal practice. So the T account, you can actually resemble, with something like a horizontal and a vertical line. But you can see this. Here's the cash account in the general ledger. See on the dates, June 1st, 2nd, 3rd, all the way down. June 1st, there was a debit for $25,000, so there was an increase in cash. On June 2nd, we paid cash for $8,000, and here's the accumulated balance. So 25 minus 8 equals 17. June 3rd, we added 4,200. 4,200 plus 17 equals 21.2. And all down here, increase in cash, decrease in cash, decrease in cash, decrease in cash, final balance. So posting. Posting is the process of transferring amounts from the journal to the ledger accounts. And you can go through this process. This actual same process, you'll see the 1, 2, 3, 4 in the actual textbook. So here's the journal entry. Cash is going to the cash in the journal ledger. Capital is going to the capital in the journal ledger. And in homework problems, you'll see reference 101 through 06. Don't worry about these. Just worry about the name of the accounts and the debits and the credits. So a review question. Posting normally occurs before journalizing, transfers ledger transaction data to the journal, is an optional step in the recording process, or transfers journal entries to ledger accounts. Correct answer is D. Transfers journal entries. Posting transfers journal entries to ledger accounts. Okay, accounts and account numbers are arranged in sequence in which they're presented in the financial statements. So the assets, you have cash, accounts receivable, advertising supplies, prepaid insurance, office equipment, accumulated depreciation, office equipment. Liabilities, notes payable, accounts payable, unearned revenue, salaries payable, interest payable. Again, keyword payable, you'll see liabilities, with the exception of unearned revenue. That means we haven't completed the process of either shipping or performing a service to a customer. That's when they give us money, but we don't do anything yet. So that will be a liability until we do something, and we can count that as revenue at that time. But we'll see that in later chapters. Owner's equity consists of capital, and you'll see the last name or the name of the owner or owners. Each owner will have their own capital account. Drawing, and income summary. Income summary, you'll see this in chapter 4 and the end of chapter 3 when we close the books. Revenues, in this example, it's just one service revenue. However, you can break that down into revenue A, B, C, or D, however you want to do it. There's no set steps of what accounts you need to have. I mean, you can have advertising supplies, you can have office supplies, I mean, whatever you see fit in your business. As far as expenses, this example, advertising supplies expense, depreciation expense, insurance expense, keyword expenses, and you'll see one deviation from this rule, something called prepaid insurance. Sometimes they call it prepaid insurance expense. Keyword you want to focus is prepaid. Prepaid will always be an asset. So I'm going to record the recording process illustrated. It looks more convoluted than it is, but let's just focus on what these steps are. Determine the type of account that is involved. Determine what items increased or decreased and by how much. And we would translate these increases and decreases into either debits or credits. So let's start up here on October 1st. Bird invests $10,000 cash in an advertising company. called Pioneer. So basically, he's investing $10,000 into a company. Basic analysis: the assets cash or the asset cash increases by 10,000. Owner's equity increases by 10,000. So this is what you're thinking about. Okay, what kind of effects is this transaction having? The equation analysis, and you'll see this one of your homework problems. Here's the accounting equation. We're going to add 10,000 to assets, and then the corresponding right side of the equation, we have an increase in capital. Debit and credit analysis. Debit increases assets. Debit cash 2,000. Credit increases owner's equity. Capital 10,000. Most important thing I want you to focus here is the journal entry. And in all the examples we'll go over the next following few slides, we'll look at the journal entry and look at the transaction. So the transaction, he invested 10,000. So there's an increase in cash for 10,000, and there's a corresponding credit to capital for 10,000. So we're increasing cash and we're increasing capital. So on October 1st, Pioneer purchases office equipment costing $5,000 by signing a 3-month note, 12%, $5,000 note payable. Basically what we're doing is go down the journal entry. We're going to debit office equipment, $5,000, and we're going to credit notes payable for $5,000. Don't worry about the 3-month, 12% note. When we deal with interest, we'll talk about that. But for now, we just record the face value of the note with the credit to notes payable. October 2nd, Pioneer receives $1,200 cash advance from a client for advertising services that are expected to be completed in December. So they're receiving a prepayment of money, and that they're not performing the service until December. So remember that word, unearned revenue. We are going to debit cash for $1,200. We're receiving cash. That's an asset, but we're going to credit unearned revenue, which is a liability. Remember, these are both balance sheet accounts. We're not going to make this revenue yet, which is an income statement account, because we didn't perform the service yet. So we received cash. Basically, our customer prepaid, and we didn't perform the service yet. So when December 31st comes, what we're going to do, and you'll see in subsequent chapters, we're going to debit unearned revenue and credit revenue. But for now, just remember, we're going to debit cash and credit unearned revenue. Okay, in this example, Pioneer pays office rent in October for $900. So they're going to pay it, and they're going to reduce their cash by $900. And when they pay expense, they pay rent on October 3rd. They pay it for October. We're not prepaying it, so we're paying it just for this month. So that's going to go on the income statement, which is rent expense. Rent expense is debited for $900. Cash is credited. Pioneer pays $600 for a 1-year insurance. Keyword 1 year. They're paying 12 months in advance, so they're prepaying. That'll expire next year on September 30th. So that's going to be prepaid insurance, the journal entry, on October 4th. We're going to debit that asset for $600, and we're going to credit cash for $600. So if you think about the accounting equation, assets equals liabilities plus owner's equity, it's only affecting the left side of the equation, which is okay. I mean, it's still going to be in balance. October 5th, Pioneer purchases estimated 3-month supply of advertising materials on account from Arrow Supply. Remember that keyword, on account. So they're not paying cash right away, but they're receiving something, and that's going to be advertising supplies. They're going to debit that for $2,500, and they're going to credit accounts payable for $2,500. So now down the road, when they pay off Arrow Supply, they're going to debit accounts payable to decrease it because they're no longer going to owe that, and they're going to credit cash for however amount they pay. They can pay in full, $2,500. They can pay half of that. But when they do pay that down, you decrease the accounts payable with a debit, and you pay that down with cash, which is going to be a credit. This goes over the basic analysis. Pioneer hires 4 employees to work. Each employee to receive weekly salary of $500 for a 5-day work week, payable every 2 weeks. A transaction has not occurred when you hire an employee. There's only an agreement between the employer and the employees. Debit and credit analysis is not needed because there's no entry. Bird, the owner, withdraws $500 cash for personal use. Basically, that's going to be a debit to drawing, $500, and a credit to cash for $500. The effect on the accounting equation, reducing assets, which is cash of 500, and we're reducing equity because we're drawing out 500. Pioneer owes salary employees for $4,000 and pays them in cash. And this is back from the October 9th transaction. Salaries expense goes on the income statement, $4,000, and we credit cash of $4,000. And you'll see that effect on the accounting equation, how this decreases assets and this decreases equity. Pioneer receives $10,000 in cash from Copa Company for advertising services provided in October. So the journal entry, we received $10,000 in cash. We debit cash for $10,000, and we credit service revenue for $10,000. Because we provided the services. In the last example with unearned revenue, we did not provide it. We were going to provide it down the road, I think in December. That's why it was a liability. But no need to record a liability here because we provided services. So trial balance. Trial balance is a list of accounts and their balances at a given time. Purpose is to prove that debits and credits equal credits. So here's name of the company, trial balance as of October 30th, a point in time, 2010. Here are your accounts. Here are your debits and respective credits. Normal balance for these four are all assets. The normal balance is a debit. Then you have notes payable all the way down to capital. These are normal balances of credit. So these will always equal. If not, there was a problem in your journal entries. 28.7, 28.7. However, the trial balance does have its limitations. Trial balance may balance even when a transaction is not journalized. So if we forgot to journalize something, it can still balance. So that doesn't mean your accounting is correct. It means the debits and the credits do equal. May balance even when a correct entry is not posted. A journal entry is posted twice. It'll still balance that in there. Just again, it doesn't mean your accounting is correct. Incorrect accounts are used in journalizing or posting, or offsetting errors are made in recording the amount of the transaction. So let's go over a review question. Okay, a trial balance will not balance if a correct journal entry is posted twice, the purchase of supplies on account is debited to supplies and credited to cash, a $100 cash drawing by the owner is debited to owner's drawing for $1,000 and credited to cash for $100. A $450 payment on account is debited to accounts payable and $45 and credited to cash for $45. This will still balance, even though it's wrong. This will still balance. What do you think about B and C? C, cash, $100 of cash, and corresponding $1,000. Obviously, that's going to be off $900, and you'll see that. So, discussion question. We can go through this during class. Ethics Insight, you'll see that in your textbook as well. And this is going to conclude Chapter 2. Thank you.